with the main aim being to help prepare you for your assessments and to give you a better understanding of the subject called tax. The way this is structured is we look at concepts that have a closer meaning or a closer connection to each other, and we go through those in these sessions. In session 1, we looked at the basic definitions or the base definitions that form part of the framework that you would have seen that you start putting together when looking at the taxable income of a company or of an individual. So in the first session, we went through the gross income definition and we went through the general deduction definition, looking at the different concepts and different parts of the definition in a little bit more detail, with the intention of simplifying those two concepts because those two concepts form the basis for any taxable income calculation. This week, the focus for today will be on special inclusions, with the second part being on exempt income, small part of today's session. And next session being on Thursday, we'll go through specific deductions. Let's go to recap. Gross income definition. We'll look at just a few items or a few parts of the definition that I want to clarify. And we will go through that last component of the gross income definition, as well as the last component of the general deduction being of a capital nature. Okay, so we'll start with just a quick recap on gross income definition, spend a little bit more time on that last part of the gross income definition, that being of a capital nature. And then we'll go into special inclusions. There are certain parts of the special inclusions of the gross income definition that are in scope, and there are certain parts that are not in scope. We will just focus a lot of our time and attention on those, just going through a few concepts and going through a few examples to land that principle in your mind. As I stated in the previous session, for me, the most important thing is having that solid base, being an understanding of the principle. Once you understand the principle, it's easy to apply that principle to any scenario that is put in front of you. And that's basically the idea behind what we're doing here. We're trying to go through all of these concepts, land the principles, with the intention being to allow you and to help you to be able to answer questions or to deal with any scenario that's put in front of you. So the principles of each and every single part of what we're doing are very important. The principles related to the gross income definition, what a resident is, what's an amount that's received or accrued in relation that, so if we go again into it, what's the concept of a resident, the total amount in cash or otherwise received or accrued by or in favor of entering such a period of assessment, excluding receipts or accruals of a capital nature. Once you understand the principles of each and every important component of this definition, a scenario that's placed in front of you, you can apply those principles to that scenario and reach a conclusion. And the last session we'll have together, we will go through a few examples, we'll go through some scenarios, and we'll see how you can structure your answer such that you can maximize on the marks you can get for any assessment that you're doing. Now, most of the assessments that you do for tax are written. There are very few where you do multiple choice or you do what's the right answer in this. A lot of it is written. And when you do have written questions that require a written solution, you need to set out your case, you need to apply the scenario to your case, and then you need to reach a conclusion. So understanding these concepts, what is a resident, what is cash, total amount in cash or otherwise received or accrued by, helps you to then take those concepts and apply them to a scenario to reach a conclusion. So first part of today, we're going to look at what is a receipt or accrual of a capital nature. Now, capital nature is not defined in the Income Tax Act. So whenever there are situations where something is not clear-cut or something is not easily interpretable, you then look to the courts to help you decide on how to treat a certain transaction or a certain event. And the courts will deliver a judgment, and through that judgment, they will provide some nuggets of information that you can use to then figure out how to deal with future scenarios. So when it comes to transactions or the definition of what not a capital nature means, as much as it's not defined, the courts have provided principles that can be applied to determine whether something is of a capital nature or whether something should be included in gross income. These principles are split into two: an objective test and a subjective test. This concept comes back again later on when you start looking at individuals and the tax, applying the Income Tax Act to individuals. I don't want to go down that rabbit hole now, but keep in the back of your mind as you go through your journey in understanding tax that the subjective and subjective test will come back again when you start looking at how you define a resident from a tax perspective. For now, for your purposes, the most important thing to understand is what is a resident in relation to a company. And we went to what does it mean to be incorporated? What does it mean to have effective management within a country? And how that then relates into determining whether a company is a resident or not. That's the only thing that's important now. When you go further, you will start going into principles that then help you determine whether an individual is a resident for income tax purposes. And in that section, you will start going through objective tests of determining whether somebody is a resident and the subjective test. For now, we're looking at whether something is of a capital nature, and there's two components: there's the objective test and the subjective test. Now, how do we define something as being objective or being subjective? Can anybody tell me what something objective is, or how something can be objective and how something can be subjective? What makes something objective? What makes something subjective? Okay, let's go through the first one. For something to be objective, it has to not be influenced by any personal feelings or opinions. It has to be based in fact. So me saying a BMW 320 is faster than a BMW 318 is fact. Not my opinion, it's not my feeling. Me saying I think a Mercedes-Benz C200 is faster than a BMW 320, unless if I have the numbers to prove it, it's based on my feeling. I think for me, looking at these two cars, one is faster than the other. That makes it subjective. I think somebody is really brilliant. Could be objective if I have marks, if I have an IQ test, if I have facts to substantiate that assertion. If I don't, then it's a feeling. And once it becomes a feeling, it's a subjective thought. So objective, something that's based in fact. Subjective, something based on feeling or a person's thoughts. It's not based on fact. So when you're looking at whether something is of a capital nature or not, there's the objective test, there's a subjective test. The objective test looks at the facts of how you acquired this asset, how long have you held this asset, what are you using this asset for, how have you treated this asset from an accounting perspective, how have you disposed of this asset. Those are facts. I acquired this asset through a purchase from so-and-so. Here's a receipt. It's a fact. I've disposed of this through the sale after holding this asset for 5 years. Those are facts that can be determined. Those are objective tests that can be applied to any asset to determine, or any transaction to determine whether it's included in gross income or whether it's considered to be of a capital nature. Then we go to subjective. It's based or influenced by personal feelings, tastes, or opinions. It's not based in fact, it's based in my own thinking or my own feelings, my own thoughts about something. Now, when I spoke about this, the one part I mentioned last week was how you treat an asset, your intention. When I buy this asset, am I buying it to hold as a capital asset or to hold as trading stock that I buy and sell? And therefore, if I'm holding it for capital purposes, or I'm holding it for a long-term period, then I can consider that to be a capital asset. If I'm holding it for a short-term period, then that's probably trading stock. What's my intention when I acquire this asset? That's not something that anybody can put something to. It's how I feel about it when I acquire it. So it's subjective. So what's my intention? Now, one thing to keep in mind about intention is intention can change over time. I can intend to buy this house. I buy a house today. I intend to sell it. If I buy the house with the intention to sell it, I'm treating it as trading stock. If my intention is to live in it and sell it after 10, 15, 20 years, I'm treating it as a capital asset. So today I buy my house. My intention is to sell it. After 2 months, I haven't sold it. I start living in it. My intention is starting to change. My intention on acquisition could have been I intend to sell this, make money out of it, therefore it's trading stock. 2 months down the line, I haven't sold this house. I'm living in it now. 5 years later, I sell it. My intention has changed. My intention could have initially been to buy and sell, therefore part of gross income. But my intention has changed. I've bought, I've held, and I've lived in it. Now it's of a capital nature. So your intention can change over time. And with that change in intention, the way you treat a transaction could change. So we've gone through the gross income definition. We've gone through what it means to not be of a capital nature, the tests that are applied. Then the Income Tax Act, when you look at the gross income definition, has a little component at the end of the gross income definition that is very important in then how determining how you treat any specific transaction or any specific scenario. So when you read the gross income definition, so if I bring up the Income Tax Act, there's a section in the Income Tax Act when you read it, gross income definition in relation to any period or year of assessment. In the case of a resident, the total amount in cash or otherwise received by accrued to or in favor of such resident. We've already gone through this. During such year or period of assessment, excluding receipts or accruals of a capital nature, but including without in any way limiting the scope of this definition, such amounts, whether of a capital nature or not, so received or accrued as are described here under. This but changes everything that we've gone through in the gross income definition. It says if anything is part of gross income, you go through the process of determining whether it's part of gross income and you get to the point where you decide, actually, this is of a capital nature and it's not part of gross income. What this section says is, if any such scenario relates to anything included herein under, even if it's considered to be of a capital nature, you include it in gross income. So you go through your process of determining, is this gross income? Is this something that relates to a resident? Is this a total amount in cash or otherwise received by, accrued to, or in favor of in a year of assessment? And you get to the point where you decide, actually, this is of a capital nature. Once you reach that point where you're saying, I'm not including it in gross income because it's of a capital nature, this part of the gross income definition says, if that, what you've determined to be of a capital nature, is one of these that is included here in after, you will include it in gross income. So once you've gone through your determination and you reach the conclusion, actually it shouldn't go into gross income, you go through and you check any of these. Is it part of those special inclusions? If it's part of the special inclusions, it goes into gross income, whether you've determined it to be of a capital nature or not. And the Act is very specific, whether of a capital nature or not. If it's a special inclusion as part of any of these subsections to the gross income definition, you include it in gross income. And that's what we'll be going through today. Special inclusions based on that specific subsection in the gross income definition that says if a transaction or any receipt is of a capital nature or not, if it's any part of this, or if you can define it as being an amount that forms part of any of these subsections, you include it in gross income. Now the Act goes through from subsection A to subsection N, if my memory serves. And from that point, you will go through each individual one and determine, okay, I've gone through my gross income definition and I've determined that this amount is of a capital nature. So it doesn't go into my gross income definition per that first section of the gross income definition. Now you go and you apply, okay, does this form part of any of these specific subsections that are special inclusions into gross income? And if it meets any one of those, it goes into gross income automatically. So you will go through that thought process of going and looking at your scenario, and you will decide, okay, is this gross income as defined? If it is, it goes into your gross income. You don't need to go any further. If your determination comes out and says actually of a capital nature, you take that and you go, okay, is it a specific inclusion? Is it a special inclusion as part of these subsections? And if the answer is yes, you include that in your gross income. So your special inclusions are covered in subsection A to N. The ones that are not in scope are the special inclusions that relate to individuals. So that's annuity payments, alimony, voluntary awards, retirement fund receipts, and commutation of receipts under contract. So that's subsection A to F of the gross income definition. But other than those, the rest are in scope. There's one more that's not included, subsection I and subsection J. But subsection JA is included in what's in scope. But we'll go through the individual ones and we'll look at different scenarios to determine, well, if I was to apply a scenario to my gross income definition, what would the answer be? Once I've applied that, do I now include it because it's a special inclusion? If the answer is yes, then it goes into your gross income. If the answer is no, you treat that as of a capital nature, and then you go into your capital gains tax definitions, your determinations, and you decide on how to include it as a capital profit or a capital loss. So let's look at the special inclusions in scope. The first one deals with lease payments or lease premiums. I've never rented, so this is something I'm speaking of from hearing it from other people. This is not from first-hand experience. But I do know if you get into a lease, you sign a lease agreement. In that lease agreement, there will be an upfront payment that you have to make. In some leases, it's the first month's rent. You pay the first month's rent as a deposit, and then you'll start paying your rental every single month from then on going forward. Now, if I say to you, I'm signing a lease today, and when I sign my lease today, I'm going to pay this first month's deposit upfront. For the person receiving that first month's rent as a deposit upfront, they'll go through the gross income definition. Yes, I'm a resident. This is a total amount I've received in cash, but this is not an amount that forms part of my gross income because it's of a capital nature. This is somebody paying me a deposit upfront for the right of use of an asset over a period of time. So this is not me selling something. The rental payments that I'll get monthly will form part of my gross income because that's rental income. But the upfront deposit This is for the right of use of this asset. Therefore, it's not of capital nature. It's not part of gross income. But then subsection F says if you've received this amount, you will include it in your gross income. So whenever you sign a lease agreement, that deposit that you pay upfront for the person that is renting out the property or the asset, that upfront payment will go into your gross income. Let's take a different scenario. You go and you want to save money in a bank account. You put 10,000 Rand into a bank account. You will get interest every single month from that. The bank will lend out your money and they'll earn interest on the back of that. That 10,000 Rand deposit that you've put in upfront for the bank, it's not gross income. But with this, it's specifically for lease premiums, that upfront payment that you make on day one when you sign that lease, that you put in there to have right of use of the asset, is included in the lessor's gross income in the year of assessment in which that payment is made or in which you sign that lease agreement. So you go through your definition of gross income, you'll get to the point of saying, wait, this is a deposit. This is not income. This is of a capital nature, or it's not gross income as defined. You will exclude it from gross income. Then you'll go through your subsections. You get to subsection F that says, hey, lease premiums, include them. Then it goes into your gross income. That's the first one. Second one is leasehold improvements. What are leasehold improvements? If I move into a building and I'm renting out a place, I arrive at this flat that I'm renting out, and the person that is renting it out to me says, I expect you to fix the bathroom. I expect you to put in, a sink. I expect you to build a cabinet or a kitchen cabinet, and I expect you to do all of these things as part of your lease that improve on the property. It could be anything. I expect you to put new doors in. I expect you to build a fireplace. Whatever improvements that you agree you will make to the property as part of you renting out that property, or as part of you renting out an asset. It could be a car. And if you're renting out a car, we agree that, hey, I'm going to let you use this car for 3 years. But as part of you using the car, I expect you to change these seats that are in this car from being cloth seats to leather seats. I expect you to put a new powerful engine in this car. I expect you to make all of these improvements to this car. For the person that is renting out that asset, you're expected to put the value of all of those improvements in your gross income. But there's an important concept that comes with this. And the important part that comes with this is that those improvements must have been agreed to, and those improvements must have been defined in the lease when you signed the lease upfront. Yes, promise.
Sorry, just to take you a bit, I'm thinking about it. The lease premiums. So which means in the first year we treat it like that. In the following year, it's the opposite. Say the tenant moves out. Now I pay them back their deposit, right?
Yeah.
Okay.
So in the first year, when you receive that premium, you put into your gross income. In the subsequent year, we'll see how we're meant to treat it when we get to specific deductions.
Oh, okay. Thank you.
But you've raised the point that I also want to touch on leasehold improvements, but we can get to that in a moment. So as I mentioned, I'm moving to this place. As part of the lease agreement, there are certain expenses I am meant to incur to improve this asset that I'm leasing. The moment we agree on this, the person who is renting out or leasing out this asset needs to include the value of those improvements in their gross income. But the most important thing is that that has to be included in the lease agreement. So I have a few questions. If it says improvement to the asset has to be agreed. You include it in the gross income in the year that you've agreed on this. What happens if this is not agreed? As part of the lease agreement, there's nothing that says I have to make improvements to this asset. What happens if I come in and I decide, actually, I'm going to add a sliding door. I'm going to take out this old wooden door that's sitting here. Or I'm going to build a fireplace so that I'm very comfortable in this place. Or I'm going to replace the kitchen cabinets and put in new kitchen cabinets. What happens if I come in and I decide to do this just because I feel like I want to improve this asset that I'm leasing or I'm renting out? What the law says and what the interpretation has been is, if you spend any money on improving a leased asset and that improvement is not agreed upon, the person who is renting out or who is leasing out that asset does not have to include it in their gross income. So criteria 1, we must have agreed to these leasehold improvements and we must have stated these in the lease agreement. If it's not stated and I make any improvements to this, you are not required to include it in your gross income. Now, what happens if I decide to spend more than what was agreed on? If we agreed I'm going to make 600,000 Rand worth of improvements to this property, the person leasing out the asset needs to include 600,000 in their gross income. But if I spend 700,000, how much is included in gross income? Only 600,000 will be included in gross income because that is what was agreed on. So another important principle, that amount has to be agreed on. If the amount for the improvements is not agreed on, the commissioner can approach the courts and the courts can determine what's a reasonable amount that can be placed on these improvements, and the value that is determined is the value that goes into your gross income. Now I've got a question there. The first question is, why do you think this is included as part of special inclusions in the gross income definition? Why should a person include the cost that they've incurred, or why should a person include the cost that somebody has incurred in improving the property in their gross income? Why do you think this was included there in the Act? Promise?
I think it's because it improves your capital asset, the value of your capital asset.
But why don't I treat it as a capital, as part of capital gains? Why don't I include it in my base cost rather than include it in gross income as required by the Act?
Oh,
You have a point. Yes, you could include it as improvement to your asset. And what I've included in the notes is, I'll explain the other part to it, which ties into what you said. But there's an important part that, from my perspective, this is not something that has come out from SARS or in any way. If I'm renting out my house, I could get rentals of, let's say, 15,000 Rand a month. If I decide, actually, I need someone to make improvements to my house, would it be fair for me to charge you 15,000 Rand a month, whilst at the same time expecting you to spend your own money making improvements to my house? Would that be fair?
No.
It wouldn't be fair. So what I would do is I would reduce your rentals to 10,000 a month, and then you'll spend additional money improving my property. But remember, when we started the conversation last week, I said there are these two opposing forces. There's the receiver of revenue on one side, SARS, there's you on the other side. SARS wants to collect a fair amount in taxes. You want to pay the least amount in taxes. If I'm an individual, I could get around paying SARS a lot of money by including in the lease agreement, you need to make improvements to my house, and I will charge you less in rentals. Since rentals have to be included in my gross income, if I'm charging you less, SARS is collecting less. By including these improvements in your gross income, it makes sure that SARS is collecting what it would collect had this not been part of the lease. So this is to ensure that people don't avoid paying the amount of tax that they would avoid by including clauses in their leases that then help them pay less tax. But now, Promise, you made a very good point around, well, this is improving my capital asset. Earlier on, I went on and I said, okay, if I agree with you that I'm going to lease this house to you for 15,000 Rand a month, you don't make any capital improvements, that 15,000 goes into my gross income. If I agree with you that you're going to pay me 10,000 a month in rentals, but you're going to make the equivalent of 5,000 Rand a month in improvements. Now, let's say those improvements come up to 500,000. That 500,000 in year one goes into my gross income. Even though you'll be making those improvements over time, in year one, I put that 500,000 into my gross income. Now, if you spend 600,000 Rand, the Act says the amount that we agreed on is what goes into your gross income. Therefore, 500,000, which we agreed on, goes into my gross income. The other 100,000 does not fall through the cracks. That other 100,000 becomes part of the base cost. It reduces your base cost. Or, on the other hand, you get more money from selling your asset. When you get more money from selling the asset, your capital profits increase, SARS gets its money. So the improvements to your house, the parts that will come into your gross income that you've agreed to, will be taxed as part of your gross income. If the person who's leasing the asset spends more, that increased spending will increase the value of your asset. That increase in the value of your asset means that you'll pay more tax as a capital gains tax. So one way or another, SARS will get its money, but it's a different amount that it will get, whether it's part of your gross income or it's part of your capital gain. But sticking to this part, leasehold improvements, you come in on day one, we sign a lease, we agree that today you're going to make improvements of 500,000 to my house. That 500,000 goes straight into my gross income. What happens for the person that's paying for these improvements? What about that person that's actually spending their money making these improvements? What happens to that 500,000 that they spent? Any thoughts? Okay, when we get to specific deductions, we'll cover this as part of specific deductions, but the person who's spending the money on these improvements is allowed to deduct those improvements. But that deduction is also limited to the amount that's agreed in the lease. So if the lease says you're going to spend 500,000 and you spend 600,000, only the 500,000 is allowed as a deduction. The other 100,000 is not allowed as a deduction. So what generally will happen is you will get companies. In my previous life, when I worked for an investment bank, we had a 12-year lease on a property in Sandton. In that lease, we were expected to make certain improvements to the building that we're working in. So companies will work into a building recently constructed, it's empty, you only have plumbing, you have water, there's nothing else. Now you walk into this building and there's nothing. What do? You start making improvements. You add certain features to this building. You construct certain things for this building so you can use it. If I'm going to build a kitchen in this empty building that I've moved in, so my staff has a place to go and eat, or a place to store their food, or a place for us to keep our milk. If I construct a kitchen, When the lease ends, I'm not going to take the tiles with me. I'm not going to take that kitchen cabinet that we put in with me. I'm not going to disassemble the kitchen and we take it with us when we leave. That will stay there. And generally, these improvements are for large sums of money. Companies invest a lot of money in creating the right type of environment for their employees. So for that company, whatever it is that we agreed we're going to do as part of the lease, they'll get that as a deduction. For the company renting out the property, whatever has been agreed to is included in that company's gross income. But again, it's important that that amount that is agreed to in the lease is what you're allowed to deduct. If an amount is not agreed to, then the commissioner may decide a fair and reasonable amount, and that amount is what goes into your gross income. So that's leasehold improvements. So of the three questions, what's the reason for this? It's to ensure that SARS does not lose out on any tax that it would earn because somebody is paying less tax because they've made improvements to a property. That's my view. SARS has not come out officially and said, we're doing this for this reason. For me, I believe that if I'm going to charge you rentals, at the same time, I expect you to make improvements to my property, I'm going to charge you less in rentals. If I'm charging you less in rentals, less goes into your gross income, SARS gets less tax. To close this potential loophole where people can actually get into a situation where they have an agreement that converts some of that income into capital and you pay less tax, SARS wants you to include it in your gross income. The other person gets a deduction, so there's a balance there. What if the improvements are not agreed on? If we haven't agreed on these improvements, nothing is included in the gross income and nothing gets deducted by the other person. But once you make improvements to a property or to an asset, the value of that asset increases. Once the value increases, the capital gain will increase. When you get a higher capital gain, you'll pay more tax. And what if the amount exceeds what was agreed upon? Only the amount that is agreed upon goes into your gross income, and the other party gets a deduction for that amount. Now, there are other parts to this that look at how it's actually implemented in practice, but we're not going to go into that because what we're focusing here is the act as it is and how it's meant to be applied. People have applied to the commissioner to say, well, if this person is making improvements over a period of time, for example, and these improvements are tens of millions of rand, I'm not going to see the benefit of these improvements until I sell the asset at the end. But I'm expected to include all of this upfront in my gross income. Is there a way to smooth this out over a period of time? Those are things that they've been considered, and those are things that you would actually see in practice happening. But for the purposes of today's session, the full amount, the full value of those improvements is included in your gross income in the year of assessment that lease agreement is signed. Even if you're doing these over a period of time, the full value of those improvements is included in your gross income in that year. Okay. So next section deals with the process from disposal of certain assets. Now, reading section J or subsection J of the gross income definition. The first section deals with mining assets and the value included in your base cost, etc., etc. That's not covered here. What's covered here is a process from disposal of certain assets. What kind of assets? These are assets that are manufactured, produced, constructed, or assembled by the company itself. So here's a scenario. I'm a developer. I'm a property developer. If I build houses, my trade is to build and sell houses. Therefore, For me, that is trading stock. It will be included in my gross income. But if you're a company that doesn't construct houses or construct buildings, but for a specific purpose, you needed to produce something. I needed to produce this building to be able to work in it. But then after I constructed, I decided I'm going to sell it. My intention has been to build and hold, but my intention has changed, has changed from building to hold to build to sell. That goes into my gross income. But if I'm a company that produces these kind of assets myself and I sell them, irrespective of what I use these assets for, irrespective of what my intention is, the value of that asset when I sell it goes into my gross income. So if I produce a machine, once I produce that machine, I produce machine for use in my factory. When I sell that machine to somebody else, my intention when I produced this machinery was to use as a capital asset. It was to produce items that I could sell. But because this is a machine that I produced myself, selling that machine changes it from being a capital asset to being a receipt that's included in your gross income. That important component of you manufactured or you produced or you created this asset to yourself, whatever your intentions are, however you use it, that is no longer a capital asset, but it is something that needs to be included in your gross income when you sell that asset. So going back to that scenario of I produce a piece of machinery that I use to produce products. I sell those products on the market. Those products, part of my trading stock, that goes into my gross income. This asset that I've produced, if I go through my gross income definition, I would arrive at the conclusion that my intention in producing this asset is to use it to produce other items that I can sell. Therefore, this machinery, my intention is to use it as a capital asset. Goes back to that tree and fruit principle. The tree, the thing that produces the fruit, is a capital asset. The fruit itself is part of your gross income definition. If I produce this machinery myself, versus if I go and buy that very same machine from somebody else, on disposal of that machine, if I've produced this machine myself, I have to include the proceeds as part of my gross income. If I've bought this machine from somebody else, I have to include that as part of my capital assets and as part of my capital gains or capital losses calculation. So important to remember that the moment you have an asset that you've produced yourself, when you dispose of that asset, the proceeds from that disposal go straight into your gross income, irrespective of what your intention was, irrespective of how you used that asset, irrespective of how long you held that asset for. If you've produced it, it goes into gross income. Yes, promise.
I promise this is the last time I'm asking.
No, please. Don't.
There was a similar question in one of the assessments where you sold, so you had the asset. It's the generator question where one of the clients wanted to buy the generator. The generator so it's a generator rental business, right? Okay. So our generators are the tree. They are the capital assets, right? But there was no intention to sell the generator. Okay. So the business only sold the generator because one of the suppliers probably gave a good offer.
Okay.
But then to answer that question in one of the questions that we've been going through, it was said it's not part of the trading stock because the intention was not to sell it. So how different is that from what you are saying now?
If I'm running a generator rental company, the question then I would ask is, am I producing these generators myself, or am I acquiring these generators from somebody else and then renting them out?
Okay, he was not producing
He
them.
was not producing them.
Okay, so this applies to like manufacturing kind of business.
Whatever it is that you are, so it doesn't have to be, it doesn't even have to be part of my business.
As long
So
as you produce
as
this.
long as I produce this asset. So let's take your example of a generator company. If I build these generators from scratch myself and I rent them out, if I run an engineering company and our business is building and renting out generators, those generators, as much as I am not using them as trading stock, I'm not selling them, I am renting them out, and they would be a capital asset under normal circumstances. The fact that I'm producing them myself turns the proceeds from selling those into gross income. Can you see the
Okay.
difference there?
Yes, I see the
It's
difference.
because I've produced it.
Thank you.
Now, it's easy to do this when you are a company that is in the business of producing those things. It's very different when your core business is not producing that asset, but the same principle still applies. The moment you produce an asset, even though your core business is not producing that asset, if you produce or you manufacture that asset yourself, the proceeds on sale of that asset, irrespective of how you have treated this asset, irrespective of how you've held it, goes into your gross income. So in that scenario, Promise, the one that you're referring to, if the company was renting them out but was not producing them, it was treating those generators as a capital asset. Therefore, the proceeds would not form part of gross income, but would form part of your capital gain or loss calculation. Okay, so we've gone through a few special inclusions, gone through a few scenarios. Let's continue, we'll circle back, do a quick recap, and let's see if we can come up with a few scenarios. Please, and the floor is open for everyone to please ask any questions. Let's go through any scenarios that you've gone through in the past that you'd like to get clarity on. How do you apply them? Why is it treated this way versus another? And let's workshop this. That's the whole idea behind the session, is to workshop through all of these items that we go through from a tax perspective to help you get a better understanding of what's happening. Now, the one thing I should have mentioned up front is, please note this. This is not a lecture. This is not a tutorial. This is not a replacement for those two. And it's not a replacement for your course notes or your course material or your tutorial work. What this is, it's a way to bring everything together and look at it differently, and a way for us to engage and see if I can help you understand things a bit differently, look at them a bit differently, or help you understand things that you may have some questions about, and we can go through some scenarios and bring a lot more clarity to what it is that you're doing. So as part of the process, if you have questions, if you have any scenarios that come up in your mind that you would like to have a conversation about, please feel free to raise your hand. Let's go through them. I would also like it if I put across a question, please feel free to answer. Do not think there's anything such as a stupid or a dumb answer. There's no such thing as that. And through us going through scenarios, we will get a better understanding of the content. Promise, the question you asked earlier around that company that rents out what are these generators is a very great example of how you would interpret that scenario versus where a company was manufacturing those generators itself and goes through that same process of renting them out, but a client wants one and then it sells it. Is it a capital asset? Is it income? Those kind of scenarios, please keep them coming. If you have any questions that you require clarity on, please feel free to raise your hand and let's go through them. So Having said that, let's go through the next section. Section case deals with dividends. That's your local and foreign dividends. Now, as part of your exemptions in section 10, section 101K is your local dividend exemption. Now, we're coming here and we're saying include dividends. Then later on, we say exempt certain dividends. There's no concept in tax that says because something is included in gross income and has an exemption, that you nullify the two and treat them as this has not happened and therefore don't include it anyway. When dealing with a situation like this where you have dividends, you'll bring those dividends in based on that specific section of the Income Tax Act that allows you to bring that into your gross income, and then you will exempt them based on that specific section of the Income Tax Act that allows you to exempt that income. So you'll have an in your gross income, you'll have an out as an exemption. You don't treat them as net zero, therefore I don't include anything in my framework. That is how you will lose marks. But knowing that I've got dividends, I include them in my gross income because of the subsection, and I exempt them because of section 101K that says you exempt local dividends. You bring it in, you take it out, the net result will come through as you go through that framework and you do your taxable income. Do not net them off and come up with a net number that you put into your gross income. To get your marks, bring it into your gross income, take it out as part of your exempt income. And to make sure that you maximize on the marks, the way we learned how to do this when we were doing this as part of tax is you specify which section you're bringing this in terms of. If I've got local dividends, I'll go subsection K of the gross income definition. I'm bringing in these dividends. I'm taking them out as part of my exemptions in terms of section 101K. The two numbers will set off however much they set off. That's how you'll get your marks. So dividends, special inclusion into your gross income as part of subsection K of your gross income definition, and you exclude it as part of your exempt income in terms of section 101K. Oh, sorry, I didn't include it here. So include in your gross income, take it out as part of your exempt income. Recoupment amount that you recoup at the end when you have expended something and you recoup that amount, that recoupment is part of your gross income. Not a lot is said of this. I will rely on your cross notes and you will look into this, and whatever it is that you bring in as part of recoupments, that's what you include in your gross income. Now let's go through exempt income quickly, do a quick recap, do a few scenarios, and then we'll call it a night. So exempt income, like I said, it's exemptions in terms of subsection 10 or section 10, sorry, not subsection 10, section 10 of the gross income of the Income Tax Act. Apologies. Section 10 of the Income Tax Act deals with exemptions. One of those exemptions is section 101K, as I've mentioned earlier, and that relates to dividends. Now, as I've said, there's a gross income definition, we have special inclusions that we've gone through today, and then we have exemptions. Together with those, on your other side of it, you've got your general deduction, you got your specific exclusions. Those are the parts that form part of your gross income calculation. So you have your gross income, special inclusions, exemptions, deductions in terms of your general deduction, and your specific deductions. Then you have your capital portion of your income tax calculation that looks at your capital gains and your capital losses. So when you're doing your questions, when you're answering your questions, or when you have a scenario in front of you, remember that these are different parts of the big framework. Therefore, don't net things off and treat them as one and then just show one amount. You don't do that. You bring things in as part of your gross income definition, or you bring things in as part of your special inclusions. You take them out as part of your exemptions, or you take them out as part of your general deductions, or you take them out as part of your specific deductions. that framework, applying that framework that way, is how you get your marks. And that's the correct way of dealing with things. Netting off of things across lines and then showing just one is not the right way of doing it. So that's what I'm trying to put across here. Look at these as specific different components of your framework and treat them as such and deal with them in their different parts. Do not net things off. So exempt income is looked at in terms of two parts, or can be split into two. It's exemptions based on an institution or an activity, or an exemption based on the income itself. So what do we mean by exemptions based on institutions? In last week's session, I mentioned something called an NGO, which is a non-government organization. And what I said is an NGO, even though its activities are not motivated by the need to make a profit, does not preclude it from being a company or a entity. Profit motive does not determine whether something is an entity or not. But at the same time, if you're an NGO, a religious institution, a church, a pension fund or retirement annuity fund or a benefit fund, the income that you generate is exempt for tax purposes. So what does that mean? I'm going to use a religious institution for an example. If you've got a church, you're running a church, you get your tithe in, you get your monthly ticket money in, you get your contributions or your what do they call this again in church where you put money in a dish? Sorry, I haven't been to church in a while. Greg, remind me, what do you call it when you put money in a dish in church?
Offering.
Offering, there. Those put in your gross income, but because you are running a religious institution, all of that income is exempt. So you'll put it in your gross income and you will take it out as exempt income. And the reason for that is you're running a religious institution. You don't treat the two as net zero and then have nothing. Churches are still required to produce financial statements. Churches are still required to file tax returns. But the way that they would do their taxes is very different because it's a religious institution. Their income is exempt for tax purposes. That's different from having income that is exempt because of the nature of that income. So there's the nature of the institution that's generating that income. Then there's the nature of the income itself. When you're looking at the nature of the income itself, example of this is dividends in terms of Section 101K. Local dividends are exempt for tax purposes. So we went through specific inclusions that said dividends are included. You bring the dividends in, you go through exempt income, you take the dividends out in terms of Section 101K. That's the process that you need to follow when you're thinking about how do you deal with a scenario and how do you answer a question when it's put in front of you. You go through your thought process. Do I include this as part of gross income? Yes or not? If the answer is no, do I include this as part of my specific inclusions? If the answer is yes, include it in gross income. Is there an exemption that's related either to my activity, be it I'm a religious institution or I run a pension fund or I run a retirement annuity fund? If the answer is no, no exemption. Is there an exemption related to the type of income? So is this a local dividend that's exempt in terms of Section 101K? The answer is yes, you exclude it as part of your exemptions. Very important to follow that thought process, very important to follow those principles, and very important to apply those principles in that fashion when you're looking at how do you deal with a scenario, how do you answer a question. Okay, so we've gone through that principle of you've got your gross income, you've got your specific inclusions, we've gone through exemptions. Last week we went through general deductions. Next week we'll touch on specific deductions as part of the series on special inclusions and specific deductions, items that are dealt with specifically in the Income Tax Act that don't form part of your gross income definition or would be excluded as part of your gross income definition because they have a capital nature. And next week we'll look at specific deductions those that do not form part of your deductions because they do not fall into the deduction definition under general deductions in terms of Section 11A, but are included specifically as part of the Income Tax Act. So last week we dealt with the definitions, gross income, general deduction, how to read those, how to interpret those, how to apply those. This week we're dealing with special inclusion specific deductions, items that would not form part of your gross income as part of the gross income definition, maybe because of a capital nature, or wouldn't be part of your general deductions for the same reason, it's of a capital nature, but are included because they are specifically mentioned in the Income Tax Act. Today we've dealt with special inclusions, touched on exempt income. Next week we're dealing with specific deductions. Those two go in hand. I've looked at definitions, how to read them, how to interpret them, how to apply them, how to deal with the scenario, and how to answer it. We're looking at specific inclusions, special inclusions, and specific deductions this week. What do you include that may not form part of your gross income definition, or what may not be deducted because it doesn't fit into your general deduction definition? And how do we deal with those? So as part of today's session, we've gone through certain specific special inclusions. So I keep saying specific inclusions. Special inclusions that are in scope because they do not specifically deal with individuals. Next week, we'll follow the same path. We'll go with, sorry, not next week, on Thursday. We'll follow that same path. We'll go through specific deductions that do not relate to individuals. So individuals we don't touch on in this workshop. That's part of your third year course. It's part of your second year and first year course. I believe you're only looking at companies. So recap. We've gone through the general income or gross income definition. This is the basis for everything that goes into your income. If you go through that whole process of, in the scenario, do I have a resident, yes or no? If the answer is I don't have a resident, doesn't form part of my gross income at this current stage. As you go forward, you will start learning what you do with income that relates to non-residents. But for this specific workshop, we're dealing with residents. Is it a resident? That will be given to you. If it's a resident, tick that box. Total amount in cash or otherwise, does it meet all of these criteria? If it does, tick it. Received by, accrued, does it meet this criteria? If it does, tick it. Is it during this year of assessment, or does it form part of a future year of assessment? In which case, if it forms part of the current year of assessment, including your gross income this year, if it's a receipt that forms part of your future years of assessment, you will include it in the year of assessment in which it relates. Then we touched on the principle of what excluding receipts or accruals of a capital nature means. So we've gone through what tests are applied to determine whether something is of a capital nature. Same test would apply on the expenses side, because capital nature is something that's also included as part of the general deduction definition. And we've gone through all of these, and you get to the point where you go, okay, I've ticked all my boxes, but I've arrived at the point where I believe this is not income, but it's of a capital nature. At this point, you do not include that amount in your gross income. But then you go a step further and you say, well, the income tax says, but if you have scenarios that are included in these subsections, even if that scenario gets you to the conclusion of it is of a capital nature, you will include that amount in your gross income. So you've gone through your thought process, you've reached the point where you're saying, this is a transaction of a capital nature, it's not part of my gross income. Step 2 goes, okay, is this included as part of my special inclusions? If the answer is yes, then you include it in your gross income. If the answer is no, then you will treat it as a capital gain or a capital loss. We've gone through that thought process. We've gone through the tests that are applied to determine whether something is of a capital nature. Objective tests, those that are based in fact. Subjective tests, those are based on feelings, opinions, or thoughts. Objective tests, we can prove something based on a piece of evidence. I bought this piece of asset at a sale, or I bought it from the shop. I bought it 5 years ago. Here's the receipt. So I've held this asset for 5 years. Therefore, when I'm disposing of it, this is a disposal of a capital asset. Versus my intention when I am buying this house, I'm buying it to sell it. But if I don't sell this house and I live in it, my intention has changed. Now there has to be a process to determine what is my intention in how I use this asset. If my intention in how I use this asset is to buy and sell it, my intention at that point is the proceeds from that sale are included in gross income. If my intention changes, now I'm not selling it anymore, I'm buying it and I'm living in it. My intention has changed. It's no longer part of my gross income. It's now a capital in nature. But then I have to go a step further and go, well, are these proceeds included as part of my special inclusions? If the answer is no, I treat it as a receipt of a capital nature, and I apply all the rules that relate to capital gains and losses. If it is included as part of the special inclusions, I include it in my gross income. I don't treat it as capital profit or a capital loss. What's a scenario that you can think of? Example is the example with the generator. If I'm a company that buys generators and I rent them out, I'm using these generators as a capital asset that generates income for me. From that perspective, if I was to sell one of these generators, that generator, the proceeds from that sale will be treated as proceeds of a capital nature. Versus if I produce these generators myself and I rent them out. The only difference between these two scenarios is I buy generators and I produce generators. The way I'm using them, my intention is not different in any way. I am renting them out. But the fact that there is a special inclusion that says if you produce an asset or you manufacture that asset yourself, irrespective of what your use is, irrespective of what your intentions are, that the proceeds from the sale of that asset will form part of your gross income. So very important to remember that. If it's a special inclusion, my intentions, anything that I can bring does not change the nature of it, and whatever proceed comes from that goes into gross income. If it's part of special inclusions, even if you can argue that you treat this as a capital asset, you've held it for 20 years, the fact that it's part of a special inclusion converts that proceed to be a proceed of income in nature and goes into your gross income. So we've dealt with your intentions and how it relates to your gross income definition and the special inclusions. Then we dealt with a few other scenarios that are specifically mentioned as part of the gross income definition. Your lease premium, that upfront deposit that you get when you rent out an asset, you will include that in your gross income because of that subsection. Under normal circumstances, if you apply your gross income definition, you would arrive at the conclusion that this is not actually income, but it's something of a capital nature, and therefore I will leave it out of my gross income. But because subsection F says, or subsection H, my subsections are running away from me now. Because of subsection F, you bring it into your gross income. We dealt with leasehold improvements. Leasehold improvements is when you move into or you acquire an asset with the intention of using that asset for a period of time. And part of the lease agreement, you're required to make improvements to that asset. If a company moves into an empty building that's just recently reconstructed, and part of the lease agreement is that the company will make certain improvements to that building, the person renting out that building needs to include in their gross income the value of those improvements to the extent that it's included in the agreement. Anything over and above that, you do not include in your gross income. On the other side, the party that is incurring that expense gets a deduction for it only to the extent that it's included in the agreement. So what's very important is what is included in the agreement, what improvements are included, and what's the value of those improvements that's included. Linking that to deductions on the other side, it's also very important to state what's included and the value of that. If no value is included in the lease agreement, then the commissioner may determine a fair value for those improvements, and that's what goes into your gross income, and that's what the other party gets to deduct. So there is that relationship. If you're including it in your gross income on the one hand, the other party gets to deduct it on the other hand. But as we get to specific deductions, we'll deal with that. So always important to remember those very key principles around leasehold improvements. It has to be part of the lease. If it's not included in the lease, it's not part of leasehold improvements, and there is no inclusion in your gross income as part of this subsection. The value has to be either specified, and if it's not specified, the commissioner will determine a fair value, and that's what gets included. And only the amount that's specified in the event that is specified gets included in gross income. So if I sign a lease today as a company, I'm moving into a fully functioning building that has all the amenities that I need, that has all the facilities I need. If I decide to make certain improvements to that building because I want to make the working conditions better for my employees, the person that is leasing that building out to me does not have to include those improvements in their gross income because it was not agreed upon when we signed the lease. But if I move into a building and we agree that I'm going to build a kitchen, I'm going to add desks, and I'm going to do all of these improvements, then the person that is renting out the building needs to include the value of those improvements in their gross income, and I will get a deduction. In my mind, as I said, from my reading of this, from my interpretation of this, this is an anti-avoidance or a closing of a loophole. Because one could get into an agreement in a lease that says, pay me less rent, but make all these improvements to my property. Now, SARS, on the other hand, wants to collect as much money as it can to use that money for the betterment of the country. Therefore, it will look at this and say, well, you're earning less in rental income, therefore pay less tax. Whereas in reality, you're getting a benefit on the other side in the form of these improvements that are made to the building. So important to remember that principle. It has to be agreed on in the lease, has to be stated what those improvements are. If the amount is determined in that lease, you include that amount in your gross income in the year of assessment in which that lease is signed. If these improvements are to be done over multiple years, you will include the value of all of those improvements in your gross income in the year in which it is done. That lease is agreed on. Not in the year in which those improvements are done, but the year in which that lease is agreed or signed. The full value. On the other side, the person making those improvements gets to get that as a deduction in the year of assessment in which that lease is signed. Even if they have to do those improvements over multiple years, in the year of assessment in which that agreement is signed, that's the year of assessment in which you get the deduction. Now, Promise asked the question, what if I get the deposit this year and that was part of lease premiums, and what happens when the person moves out? If we apply a similar scenario to the leasehold improvements, but if we agree that over 10 years of this lease, you're going to make specific improvements to this building, and within 2 years you cancel your lease, what happens then? Question I will leave you with. We'll deal with it next week when we go through on Thursday, when we go through specific deductions. But that's my question to you. What happens? Promise, do you have an answer?
You can claim it back. It's deductible.
And when is it deductible? We agreed that you're going to do all these improvements over 10 years. 1 year into the agreement, you cancel the lease. So remember, in the year of assessment in which we agree, that's the year I will include it in my gross income. That's the year in which you will get a deduction. What happens if you don't make those improvements because you cancel your lease?
If you don't make the improvements, or if you don't at all.
You don't make the improvements because you cancel your lease and you ended the lease 9 years before it was meant to end. Let's say you make some of the improvements. You make the improvements you are meant to make in year 1. But the improvements you are meant to make in year 2 to 10, you don't make them because you've canceled the lease.
You claim only based on what has happened, only on the actuals. That's what I think.
Okay, that's one suggestion. Any other suggestions? By the way, promise we'll deal with this in specific deductions when you do it next week. But I want you to think about it, go through it, work through that, see what you can find, because that's a scenario that, as part of the lease premiums conversation we had around, well, what happens if you get the money up front this year and you give it back next year? How do you deal with that over the 2 years of assessment? This is part of it. What happens when we agree that you're going to make these improvements over 10 years? We take the full value of those improvements over 10 years, included in my gross income, you get a deduction. What happens when you don't make those improvements because you cancel it? Question that I'm leaving you with. We've got your thoughts, promise. For anybody else, if you've got them, please share them. Otherwise, we'll go through it on Thursday. Let's think about it and let's see what the answer is. There is an answer. I'm not saying your answer is not right, promise, and I'm not saying it's right. I'm saying let's talk about it on Thursday. But I want you to think about it, because these are things that actually happen in practice. You will find that you get into a situation where you have a set number of people. Let's take COVID, for example. You signed a lease in 2019. It's a 10-year lease. You intend on being in this building for 10 years. You make certain concessions in this agreement, and you agree that I will make improvements to this building over 10 years. This is a brand new building that's just been built. So I'll build a kitchen, I'll add desks, I will make other improvements. I'll put in air cons, I'll do all of these things that we've agreed I will do. This is 2019. 2020 hits, COVID happens. Everybody's working remotely. Now, I'm not at the building, therefore I can't make these improvements that I said I'm going to make. Part one of the problem. Part two, I've now realized that actually working remotely works for me and the people that work in my company. I no longer need to rent out this building. We can actually find a place where we can have servers that will run all of our processes, run all of our systems. And from that, we don't need to be in the office. Therefore, I actually want to cancel my lease before it ends in the 10-year period. What happens if you're a company that you're sitting in a situation where COVID hits, you had all of these plans, you had all of these contracts in hand, but now that COVID hits, you can no longer fulfill those contracts. You are no longer able to continue operating as a business. But you had all of these things that you agreed upfront in the lease. You've included that in your gross income as the party that's leasing out the building. You've gotten a deduction as the party that's making these improvements or that's meant to make these improvements. COVID hits, your business cannot survive post-COVID. Now what happens? These are situations that have actually happened out there in the world, where companies had plans that they've made based on the world being normal in 2020. And then 2020 happened, COVID happened, everybody's world changed. Now you've got the Income Tax Act that says you have to do things in a certain way. But the Income Tax Act is written under the assumption that we will continue operating under normal circumstances going forward. Situations like COVID are not considered when you're doing these acts. So that's the scenario I'm going to put out there. What happens if 1 year into the lease, we've agreed that you're going to make improvements over 10 years. Now we're 1 year into the lease. Something happens. Anything can happen. You go out of business. Things change. COVID happens. Anything can happen. But something happens that after year one, you now need to cancel this lease. What do we do then? And we'll go through that on Thursday. So we've covered lease premiums, we've covered leasehold improvements, process from disposal of certain assets. As I mentioned earlier, if you've manufactured this asset yourself, if you've produced it, you've constructed it, you've assembled it, irrespective of the use of that asset, irrespective of your intentions, irrespective of anything that would lead you to conclude that the proceeds are of a capital nature, because of the subsection you included in gross income. Very important to go through that thought process. I start with my definitions. Does it form part of my gross income based on the gross income definition? Answers yes or no. If it's yes, put it into gross income, forms part of your gross income definition. If you get to the point where you say no, you go through the subsections. Is it included as a special inclusion based on all of these subsections? If the answer is no, then is it of a capital nature? If the answer is yes, you treat it as part of your capital profit or loss calculation. If the answer is yes, you bring it into your gross income, irrespective of whether your determination when you're going through your gross income definition was that this receipt is of a capital nature. Very important that you keep those principles in mind. You apply your definition to a scenario. Once you apply your definition, you get an answer. You go through your special inclusions or your specific deductions. If it's treated as part of those, you get an answer. If it's not, is it capital in nature? Then we go to our capital profit or loss calculation. Then we get our answer. And that's how we start populating that framework that you've got that determines your taxable income at the end. Go through your definitions, understand your definitions, both your gross income, your general deduction. Understand all the criteria that's related to it. Where the criteria is not clear, there have been court cases that have helped us make clarity around those. You apply your court case. If you determine that, nope, it's not part of gross income, or it doesn't form part of my general deductions in terms of section 11A, you go to your next step. Special inclusion or specific deduction. If the answer is no, you go to your capital. Then you determine where it falls in. Why is this important? Once we get to the part around capital profits or loss, if all amounts were taxed the same, whether they were income or capital in nature, there wouldn't be that big of a difference whether you include it as gross income or you include it as capital profit or loss. But because capital profits or loss are taxed differently from what's in your gross income, it's very important to know whether something falls into gross income or whether something is a capital profit or loss because of the different tax treatment. Are there any questions? Is there any area that needs further clarity? Are there any scenarios that you've dealt with? Greg, there's a question in the chat. The answer is yes from the top of my head, but Greg will be able to tell me if I'm telling the truth or not. Greg, did you see the question in the chat?
Yes, I saw it. I'm replying to it.
Thank you very much. I hope I'm not lying. So any scenarios, any situation, any question that you have, if you've gone through your course content, you've gone through your tutorials, there's that nagging question that you've got that you want to deal here, please bring it in on Thursday. Let's go through it on Thursday. Otherwise, we've got 15 minutes. Happy to open the floor for any questions or any areas that you would like me to clarify a bit more, any items that don't make sense that you'd like me to provide a bit more clarity on. Okay, please, once again, feel free to bring any questions or concerns that you have for our next session on Thursday. Happy for us to go through them. Whole idea is for us to debate these principles, go through different scenarios, and figure out the answer together. Once we get to the last session where we go through exam technique, how to look at these things, how to answer a question for tax, and how to structure those answers, we'll go through a few scenarios then as well. So if there are any issues that you feel you're not comfortable bringing them to this forum, hopefully we'll go through them when we go through the last session. But feel free to bring any questions that you have to this, and let's debate and let's discuss. That is it from me for today.